If you renovated your home between 2020 and 2023 and paid any contractor in cash, you could lose $20,000 or more when you sell. And the CRA is already auditing these cases right now, not because you did anything illegal, because you cannot prove what you spent. And in the eyes of the Canada Revenue Agency, money you cannot prove you spent is money you never spent at all. Welcome back to Canada Property Watch. In part 1 of this series, we exposed how the CRA denies the principal residence exemption when your use of the property raises questions. In part 2, we showed you how the agency reaches back into transactions from 3 years ago using the normal reassessment window before it expires. Today, in part 3, we expose the trap that connects directly to both of those investigations. It is called the adjusted cost-based audit, and it is the mechanism that takes the money you invested in your home and hands it to the Canada Revenue Agency on the day you sell. Here is the number that matters before we go any further. If you cannot document a renovation expense to the CRA's standard, that expense is treated as zero, not reduced. Zero. Every dollar you spend improving your home that you cannot prove with documentation the agency accepts is a dollar that does not exist in the tax calculation. And that invisible spending is added directly to your taxable capital gain when you sell. Here is how this hits you in real money. You bought your home for $800,000. You spent $200,000 renovating over 5 years. You sell for $1.4 million. Your capital gain should be $400,000, but if you can only document $120,000 of those renovation costs, the CRA calculates your gain as $480,000. That $80,000 difference, the money you actually spent but cannot prove, adds approximately $20,000 to your tax bill at Ontario's marginal rate. $20,000 gone, not because of a market loss. Not because of a bad investment, because you paid a contractor in cash and did not get a receipt. Let me say this clearly. The CRA is not asking what you spent. They are asking what you can prove. And if you cannot prove it, legally, it never happened. This is the trap. And it is closing right now on hundreds of thousands of Canadians who renovated during the pandemic years and are beginning to sell. To understand why this crisis is happening at exactly this moment in 2026, you have to understand the scale of what occurred in the Canadian renovation market between 2020 and 2023. When the pandemic hit and Canadians were confined to their homes, two things happened simultaneously that had never happened before in the residential construction industry. Demand for renovation services exploded as homeowners decided to improve the spaces they were now living in around the clock, and the supply of licensed registered contractors collapsed almost immediately as border closures, material shortages, and public health restrictions reduced capacity across the industry. The result was a renovation economy operating at maximum pressure with minimum oversight. Licensed contractors with proper business registrations and invoicing systems were backlogged for 6, 8, 12 months. Homeowners who could not wait turned to informal tradespeople. Referrals from neighbors, workers found through Facebook groups and community boards, and the informal networks that expand rapidly when formal channels cannot meet demand. These informal workers did not issue invoices. They worked for cash. They did not want a paper trail any more than some homeowners did. The transactions happened, the work was done, the money changed hands, and the receipts that should have been created were not. Statistics Canada data shows that residential renovation spending in Canada increased by nearly 40% between 2019 and 2022. Billions of dollars flowed through the renovation economy during those years. A significant portion of that spending occurred through channels that left no documentation trail suitable for the Canada Revenue Agency's evidentiary standard. Those undocumented transactions are now sitting inside the adjusted cost-based calculations of hundreds of thousands of homeowners who are preparing to sell in 2025 and 2026. The agency knows the renovation boom happened. It knows the informal cash economy expanded during those years, and its compliance systems are calibrated to identify the gap between what homeowners claim to have spent and what the documentary record can support. To understand exactly how the adjusted cost base works, here's the mechanism in plain language. When you sell a property, means your capital gain is calculated as your sale price minus your adjusted cost base minus your selling costs. Your adjusted cost base starts at the price you paid for the property, but every capital improvement you make adds to that base. A new roof, a kitchen renovation, a finished basement, new windows, a new bathroom. All of it adds to your cost base. A higher cost base means a lower capital gain, which means less tax, which means more money in your pocket on closing day. But here's where it gets dangerous. The CRA does not accept your memory. It does not accept your estimate. The burden of proof is entirely on you, and the standard is specific. The CRA requires an original invoice showing the vendor's name, business address, or registration number, the date, a description of the work, the amount charged, and evidence of payment. A bank transfer to a contractor named Mike does not meet this standard. A credit card statement without an accompanying invoice does not meet this standard. A text message confirming a cash price does not meet this standard. And a cash payment with no receipt does not meet this standard under any circumstances. It is also important to understand the distinction between a capital improvement and a repair or maintenance expense, because this distinction matters significantly for the adjusted cost base calculation. Only capital improvements add to your cost base. Repairs and maintenance do not. Replacing a broken window is a repair. Replacing all the windows in the house as part of a comprehensive upgrade is a capital improvement. Fixing a leaking roof is a repair. Replacing the entire roof is a capital improvement. Painting the interior is maintenance. A complete interior renovation, including new drywall, flooring, and fixtures, is a capital improvement. The CRA applies this distinction strictly, and the burden of demonstrating that an expenditure was a capital improvement rather than a repair falls on the taxpayer. If you cannot document not only the amount spent, but also the nature of the work performed in sufficient detail to establish that it was a capital improvement, the expense may be denied on two separate grounds. This is the exact moment people lose money, not when they make the cash payment, when they go to sell the house and the CRA asks for the receipt and the description of work that do not exist. Let me show you exactly how this turns into a financial disaster. Let us call him Robert. He bought a home in Vaughan for $840,000 in 2017. Between 2020 and 2022, he spent $226,000 renovating. Full kitchen, finished basement, new roof, new windows, driveway. He was building equity. He was investing in his home. He was doing what every financial advisor and real estate agent told him was the smartest thing he could do with his money during a period of rising prices. He paid some contractors properly with invoices. He paid others in cash because they offered a discount and he was busy and he trusted them. He kept some receipts. He lost others. Life moved on. Three numbers tell the entire story. Total renovation spend, $226,000. Amount Robert can document, $110,000. Or amount the CRA denies, $116,000. Robert did not lose this money because of a bad renovation. He lost it because, in the eyes of the Canada Revenue Agency, over $100,000 of his investment never existed. The tax on that denied amount at his marginal rate is approximately $30,000. The gross negligence penalty under Section 163(2) of the Income Tax Act adds another $15,000. Interest compounds daily from the original filing date. Robert's total liability from undocumented renovation spending exceeds $45,000. That $45,000 was not a market loss. It was money he already spent, building a home he loved, improving it for his family, and then lost a second time because the folder was not organized. He paid for the kitchen twice, once to the contractor, once to the Canada Revenue Agency. The contractor at least gave him granite countertops. The CRA gave him nothing except a registered envelope and a payment deadline. Now here's the part that should stop you from thinking this will not happen to you. The CRA is not randomly auditing homeowners. It is selecting files where your data already tells them something is wrong, and it has the data before it opens a single file. When you pull a building permit, that permit is registered in a municipal database the CRA can access. The permit lists a project value. If your invoices account for $38,000 of a $64,000 permitted project, the agency sees a $26,000 gap. That gap is a direct audit trigger. No tip required, no complaint needed. The data mismatch fines you. The contractor who worked on your home is also a registered taxpayer. The CRA can compare their revenue filings against the invoices you submitted. If the numbers do not align, the case builds itself. This is not random enforcement. This is systematic selection based on data the government already holds. There is a specific and additional trap for homeowners who received a Canada Greener Homes grant between 2021 and 2023. The CRA's position is that your adjusted cost base can only be increased by the net amount you actually paid after the grant. If you spent $15,000 on insulation and received a $4,000 government grant, only $11,000 adds to your cost base. Many homeowners who receive these grants overclaim their cost base adjustments without realizing it. That overclaim is its own exposure point if the file is ever reviewed. There is also a trap specific to homeowners who did substantial renovation work without pulling the required building permits. In most Ontario municipalities, renovations involving structural changes, electrical work, plumbing modifications, or additions above a certain value require a permit. Many homeowners skipped the permit process during the pandemic renovation boom, either because their contractor discouraged it, because they wanted to avoid triggering a property tax reassessment, or simply because the permit office was backed up and they could not wait. The absence of a permit creates a specific problem for the adjusted cost base claim. The CRA has no permit record to corroborate the claimed improvement. The contractor may have no registered business record. The only evidence of the work is the homeowner's own claim, supported only by whatever documentation was retained. In these cases, the CRA's evidentiary bar is effectively higher because there is no third-party record confirming the work was even performed. So what does the CRA actually accept as proof? The agency accepts original invoices meeting the full standard described above. It accepts bank statements when accompanied by supporting invoices detailing the specific work performed. It accepts credit card statements with the same requirement. In limited circumstances, it accepts statutory declarations from contractors confirming the nature and cost of work performed, though these are subject to additional scrutiny and are not preferred. It accepts building permits and inspection certificates as corroborating evidence that work of a certain scope was performed, though not as standalone proof of the cost. And in some cases, it accepts professional appraisals that reconstruct the cost of improvements through a materials and labor analysis at the time the work was performed. These appraisals are expensive, they take months to prepare, and the CRA has full discretion to reject the methodology. They are a last resort, not a reliable solution. Here's the checklist you need to apply today. Pull every record you have for every improvement made since you bought your current home. Go back to the beginning of your ownership. Separate everything into 3 categories. Category 1 is fully documented with original invoices showing the vendor details, description of work, date, knowledge amount, and evidence of payment. These amounts are safe and will be accepted. Category 2 is partially documented. You have some paper but the invoice is incomplete, or you have a payment record without a corresponding invoice. For every item in this category, contact the contractor now and request complete documentation while they are still in business and accessible. Explain that you are preparing for a potential property sale and need complete records. Many contractors will cooperate. A retroactive invoice is not ideal, but it is substantially better than no documentation at all, and the CRA will consider it alongside other corroborating evidence. Category 3 is entirely undocumented. Cash payments with no receipt, no contractor who can be reached, no permit record, no corroborating evidence of any kind. For these amounts, you need to have an honest conversation with a tax accountant about whether a professional reconstruction appraisal is financially feasible given the dollar amounts involved and the likelihood of a CRA review. Here is the time pressure you need to understand completely. Every day you wait, the contractors who worked on your home move closer to being permanently unreachable. Small renovation businesses close constantly. Individual tradespeople retire, move provinces, change phone numbers. The informal workers who dominated the pandemic renovation economy are particularly likely to have moved on in ways that make them impossible to locate years later. Because once the contractor disappears or closes their business, your ability to fix this problem disappears with them. There is no mechanism for reconstructing documentation that no longer exists from a source that is no longer accessible. The window to retroactively document your renovation spend is not infinite. It is closing every single day that passes without action. If you are planning to sell within the next 2 years, the time to identify and address the documentation gaps in your renovation records is today, not the week before closing, not when your accountant asks. Today. For the Canadians watching this who were priced out of the housing market during the renovation boom years, who watched neighbors pour money into their homes and then list them at prices that made the market inaccessible for working families, this part of the story has its own particular ledger. The cash economy that funded those renovations, the informal contractor relationships, the willingness to operate outside the documented economy to save a percentage point on labor costs, those decisions were not consequence-free. They were consequences deferred. And the deferral period is ending now as those same homeowners prepare to sell into a market where the CRA's data matching capabilities are more sophisticated than they were when the cash changed hands. The renovation that was supposed to be the financial crown jewel of the ownership years is becoming, for some of those homeowners, the source of a tax liability they never anticipated and cannot easily resolve. Most homeowners think renovations increase their wealth, but without documentation, renovations can actually increase their taxes. And the worst part is, most people only realize this after the sale is already done. If you cannot prove what you spent, the CRA keeps the profit you thought was yours, and there is nothing you can do about it. In our next investigation, we are going to expose a trap that is targeting the hundreds of thousands of Canadians who have been using their tax-free savings accounts in ways the CRA has specifically identified as aggressive. If your TFSA has grown significantly faster than passive investment returns would suggest, if you have been actively trading securities inside the account, or if you have transferred assets in ways designed to extract gains tax-free, the agency has a specific and expanding audit program targeting exactly this behavior in 2026. The account the government told you was permanently tax-free is becoming the account the government is examining most closely. Subscribe to Canada Property Watch right now and enable your notifications because that investigation will reframe everything you thought you understood about your most protected financial asset. The words tax-free are not as permanent as they sounded in 2009.